How's it going? My name is Joshua Stanton. I'm the mortgage dude, and I'm a senior loan officer with CMG Financial. And today, my guest and I are going to be talking about the all-in-one loan. Let's get right to it. I'm lucky enough to be joined by the VP of All-in-One Finance, Mr. Dave Herbst. How's it going, sir?
Good, Joshua. Good to be with you again.
Thank you. So want to get right into it, talk about the best mortgage in America, my humble opinion, something that I personally use and Dave does too. Want to talk about the all-in-one loan. Dave, can you break the all-in-one loan down a little bit for us and tell us what it is?
Yeah, I mean, you've already kind of touched on it. It is definitely a solution. It's actually, one of our previous taglines to the product was that it's not just another loan; it's a solution to the loan itself. The all-in-one is a mortgage product that you can apply for purchasing real estate, whether that's your primary residence, a second home, or an investment property. You can also use it to refinance out of a current mortgage and into this one. What it does is it helps you minimize the amount of interest you pay over the life of your loan. It also minimizes your monthly mortgage expense. It's a product that pays down principal first. So it's the only loan in America that actually pays down your principal by every dime you put towards it before it computes interest. It also is the only loan in America that provides you access to your home's equity dollars, as well as the money you use to pay down your principal freely for 30 years without having to refinance. It's structured differently, in which gives it all these benefits. It's a combination of a 30-year draw home equity line of credit. That's your primary mortgage with this product. It takes over any other mortgage liens on the house. It's the only mortgage on the property. What makes it even more powerful is that it's integrated with a fully transactional, secured personal checking account. The checking account, in other words, comes integrated in with your mortgage. Now, this is a benefit because you are able to actually use your income dollars to reduce your principal balance every single day that you're not using your money. So in other words, most of us have bills and expenses to pay for each and every single week or month. But the reality is that we don't use those dollars every day. We don't go grocery shopping on one singular day for the month for all the food that we need to eat over the course of that month, right? So our money sits around, daily idle, waiting to be spent on our bills and expenses. So generally, those dollars float or sit idle in a checking account. So by integrating the checking account with the mortgage, your money now goes further. It's in this loan, it's automatically compressing your principal balance on a daily basis in which interest is computed. So therefore, it automatically limits or reduces the amount of interest you have to pay each month, annually, and in total. That gets you out of debt faster. So a lot of people call it an accelerated mortgage. It actually reduces your payoff timing, minimizes it down to 8 to 12 years on average. So it speeds the process up and saves a lot of people money.
Yeah, absolutely. I'm seeing that projection with a lot of the clients I'm closing this loan with right now. I mean, we project them at worst case scenario, and we don't know what's going to happen in the future. You get the keys to this amazing tool and you drive it. But a lot of these customers that I'm closing, I'm thinking to myself, you're going to close faster than you think on that, or you're going to have your payoff faster than you think on this, I believe. But so. Talk to me a little bit about where this loan or where the idea for this type of loan comes from, because obviously this is new. People's heads are probably exploding right now while they're listening to you because they're like, it does not compute. All I know is 30-year fixed amortization schedule.
Yeah, sure. It's not a new idea by any stretch. The idea of kind of avoiding mortgage interest or interest cost on any, borrowed funds is, of course, decades and decades old. People have been, strategizing and creating ways to kind of beat the system or beat the bank, if you will, on loan programs forever, it seems. The all-in-one loan originates in countries like Australia, New Zealand, Canada, our friends throughout Western Europe, where these types of loans or similar loan programs have existed for decades, really. The reason these types of loans have existed in those parts of the world, ultimately because many of these countries have eliminated any interest deductibility benefits when you pay on a mortgage. So no longer in many of these countries are you able to actually deduct the interest to reduce your tax liability. Here in the United States, of course, we still get that benefit. But in these countries, it really sparked the innovation because sort of the revolution began to kind of take hold. If you can no longer deduct interest on your mortgage, lenders sought ways to change the way the mortgage was structured so that customers could essentially reduce their exposure to mortgage interest. We believe as an organization that not only are we responsible for helping qualified customers get into the right loan for the right reasons at the right time and thus providing debt, but we also think we're as responsible for helping people get out of that debt, making it easier. So we pioneered this program really after those types of loan programs that exist in other countries. We put it to market first in 2005. So it's not a new idea, it comes from other parts of the world. We just created an American version of it, if you will, and launched it nearly 16 years ago, next month, actually. It has origins rooted for very good reason, helping people minimize their interest expense and pay down faster and create that incentive to do so. Sadly to say, that's not an American idea. It really came from other parts of the world.
I agree with you. It's one of the reasons why I love the all-in-one loan. Because it's a vehicle for help. You can help people pay off their biggest debt, most people, the biggest debt in their life in half of the time or less, most of the time, a lot less. So if you're getting rid of that huge debt, you're getting rid of financial risk in your life.
Yeah.
And I love it. And I think that kind of resonates with people. Let's talk a little bit about this being a financial tool in a little bit more detail because I have it. I personally treat it as a financial tool. I run all my money through it, my wife and I, because we understand how it works. We understand how this is going to benefit us in the short and long term. I try to talk to as many people, but especially people like financial advisors as I possibly can, because I think that everyone needs to understand, at least understand what this thing can do for them, whether or not it works for them. It's a different topic. Everyone's different. I, explained this to my financial advisor. He loved it. He understood it.
Yeah.
He's a very intelligent man, which boosted my confidence too, because he knows how to make money and he knows how to help people make money. And he's like, okay, I'm going to do this loan. This is great. How do I get started? So he's now doing it. He refers me to a ton of his clients who are now our clients. It's been amazing, but can you talk to me a little bit about why financial advisors should really partner with us?
Yeah, enormous opportunity. And that's exactly right. I think it's a paradigm in itself when you actually refer to a mortgage as a financial tool. The truth of the matter is that most Americans need to borrow money in order to buy and maintain possession of real estate. It's roughly about 54 million borrowers today. And like you said, collectively owe somewhere near $11 trillion in just mortgage principal. Despite low interest rates that we've all benefited from over the last few years, the truth is that mortgage debt continues to remain high and actually increase. You mentioned the amortization schedule. Mortgages are a mere repayment plan. That's really how I like to think about them because it's the truth. It's a scheduled, predetermined repayment plan of the principal you needed to borrow. The customer, the borrower, is not in control of how much of their money on a monthly basis goes towards principal versus interest. That's all predetermined and defined, along the way. And that's what artificially keeps your balance higher than necessary. And of course, what ends up costing you more in the long run, more than is necessary. So, you can ultimately take an extremely low interest rate loan and you still pay high amounts of interest on that loan. But this is the paradigm we live in where we've almost been kind of programmed over several decades, I believe, generationally. To believe that the interest rate is the most important component of how you borrow and how you pay for things that you needed to borrow money for. And it's actually not. Your balance is, how much you owe right now. Who's controlling that? Is it going down slowly or is it going down as aggressively as you possibly can reduce it? Those things matter more mathematically and financially. If given the choice, would you rather pay higher interest or lower interest on your borrowings? And it ultimately just comes down to that question. Mortgages are a financial tool. It's odd that 9 out of 10 Americans statistically choose the exact same financial tool to finance their real estate with structurally, even though a borrower is different. They have a lot of similarities, but they're different. They're different with their goals, are different with their challenges and their financial means, their income levels and things like that. But they choose nearly identically the same financial tool to, to help them. And it's just an odd thing. One of the biggest advantages of the all-in-one loan is it's open-ended. It allows you to freely put as much money as you possibly can or want to into it. That reduces your daily principal. Now, by doing so, interest recomputes on your daily principal. So if you just reduced it by your paycheck or the amount of money you had in your savings account yesterday, and let me pause really quickly right there. Think about where we flow our cash, our cash flow. Most of us use a checking account, right? And these checking accounts typically see more money in just 5 years than the average household owes on their mortgage. The problem is that those funds are kept separate from your mortgage liability. And that's why it takes 30 years. It's partly the reason why it takes 30 years or 40 years or 60 years to pay off a home in America, if ever, right? And in the meantime, your money as it flows through a checking account or a savings account is earning significantly less interest than you pay on your debts. So, that's where the magic really comes from, or is really structurally is really anchored to, is the integration of the checking account, the facility in which we manage our income dollars with into the mortgage debt, just to minimize the expense of that mortgage debt. So, the financial product and the paradigm shift, I think, for people in thinking that this is a financial tool, it is, and it leads to opportunities if you utilize it, right? If you put it in place, it's just a more efficient financial tool and financial product to get you where you want to go. It's really that simple.
And I'm going to rehash a little bit of what you said, but when I talk to financial advisors, I tell them, hey, if you can tell your client right now that they can live the exact same lifestyle that they are living currently, giving you money, paying for their trips, going out and buying new things, whatever, their lifestyle right now, and they can pay off their mortgage in maybe like 10 years or less. If you said you have a tool and, call this guy and he's going to help us out, do you think that that's going to be good for your business, and good for your client's future? I mean, bottom line, because if they have 10 years versus 30 years of the biggest debt in their life, what are they going to do with their money? That extra 20 years that they don't have, and that to me that's extremely powerful. I use that all the time. And some people get it, right? Sometimes I do talk to financial advisors and they say, well, I could take people's extra cash monthly, their cash flow. Yeah. And I could make a lot of money with that. I'm like, well, why aren't you doing that right now?
Really just comes down to the math, right? And how that impacts you financially. You don't really have to, be a math wizard to understand what's more costly and what's more appealing, what's more beneficial, I guess. Yeah. If we were just to compare very, very quickly, and I use extreme examples sometimes, just kind of awaken the mind and get people to start thinking, what's less expensive, a 10% mortgage that is designed to pay off in 5 years, or a 2.5% mortgage that's designed to pay off in 30? Which one would we flock to emotionally? We immediately go with the 2.5% mortgage is the one that's going to be better for me. If your goal is to save money and time and also create some optionality, high optionality, right? Have opportunities to invest more aggressively sooner, then that 10% mortgage is significantly better for you, right? Not that this loan is at 10%, but just to give an extreme example of how, it just comes down to math, and you really have to untether yourself from this programmed, narrative, in a sense, that interest rate matters the most. Refinance again, refinance fast, hurry before rates go up. Resetting that clock and relinquishing control of what your principal balance is, that's what's causing the damage. Right? Think about it that way. The less control you have in terms of what you owe and how soon or how long it's going to take to pay off, that's what's causing the damage financially. And you mentioned it earlier. You mentioned the the retirement income deficit that continues to widen. It's true. People are not on track to have enough money saved to afford the way they live currently during their retirement years. That's a gap that is studied by a think tank called the National Institute for Retirement Security. And that gap, it continues to widen and widen and widen. You just cannot ignore the mortgage as being one of the culprits, one of the problems, right? So, avoiding mortgage interest expense and taking greater control of your principal balance and your payoff timing means that you can get ahead further and meet your retirement goals on time, if not earlier.
Absolutely. It simplifies things. I remember I was thinking to myself, okay, I'm gonna have to link all these things to it to build it the way that I want to, because it is, like you said, it's a new checking account for us. And we run all of our money through it. But once you get it set up, which is actually extremely easy, it's just kind of set it and forget it. And psychologically, what happens to a lot of people, for instance, myself, is you find money that you didn't necessarily think you had before, or you thought was yielding you a good amount of return in something else. But then you realize, wait a minute, this is far superior. Well, I'm going to use this tool instead. And that happens to clients all the time. I'll call them up a few months later. Hey, how's it going? Oh, Joshua, I didn't tell you I had $50,000 in this, money market account that's yielding me 2%.
Right.
I just took that 50 grand and put it right into this. And now my payoff is, a couple few years quicker, and I'm going to save this much more money, or whatever the case may be. And that's exciting. That's why I love this.
Yeah. From my experience, I think that the reason why it's really not taught and made as a primary focal point is because in order to do that, you've got to really commit, and sacrifice dollars towards a financial instrument that doesn't keep those dollars liquid, right? So there's some risk involved. So I think from the advisor's perspective, and I don't mean to speak for the advisor community or the industry by any stretch, but from my understanding, of our industry, what we offer, predominantly are closed-end mortgage products, right? Financial products that are closed-ended. They're only one-way instruments. You put your money into it, the minimum required amount, and think about it. These tools create the incentive to only apply the minimum amount, right? Because they're closed-ended. You don't want to necessarily apply more than the minimum because you don't have access to those funds any longer. So I think from the fiduciary's perspective, it's risky. And there's other ways to use those idle dollars, right? The residual cash left over after spending each month. There's other places to tuck those dollars away that could then, turn into, savings and also, retirement security. It's a slow journey to do that. But I think from the fiduciary's perspective, mortgages are a pretty risky tool, and they're so rigid, it just doesn't give a lot of options. The focus just seems to be primarily, let's lower your rate, lower your payment, freeing up any extra funds each month so that we can use those dollars, towards savings and creating retirement security and these other things. So I don't fault them for that mindset, but it's anchored to the structure of the mortgage industry, right? So what if we restructure the way a mortgage works? What if we said, hold on a minute, you don't have to make that choice. In fact, you get to use your grocery money to reduce your daily and monthly interest expense on your mortgage before you go buy groceries. You can use your gas money before you fill up your gas tank tomorrow or the next day or next week to help you save in daily and monthly interest expense prior to spending those dollars, right? The utility bill money that you're going to spend in 3 weeks for the month of June, right, hasn't been spent yet, but it's probably sitting in your checking account. Those dollars could be utilized right now to save you mortgage interest expense at the rate of the loan itself. So the savings benefit is far more significant than the earnings benefit with those dollars sitting in a checking account, traditional checking account, right? And that's where really the magic of the loan takes over. It's just there's really no secret to it. It's applying more money on a daily basis towards your principal balance to compress what you're going to have to pay in interest cost. It's just that simple. And it keeps the money freely available to you 24/7. And it's made easy because, of course, the way you engage your cash and your home equity dollars and your mortgage principal is through the checking account. ATM debit Visa cards are issued, check writing, online banking, mobile banking, bill pay, ACH transferring, wiring money domestically and internationally. You can link external accounts to it, fully visible on a daily basis, moving money in, moving money out, however you want to do it, all to help somebody control what they owe and how much they have to pay on those borrowed funds. So it really does become an enormous, I think, benefit to help financial advisors help their customers get ahead sooner and more efficiently.
Well, thank you, Dave.
Of course.
You and I could sit here all day talking about this and how much we love it. I'm going to let you get back to it. I want to thank you for taking some time on this call with me. And if listeners have any questions about the all-in-one loan, if you want to see a personalized simulation, I can do that for you. Just get in touch with me through email is probably best. You can get me at jstanton@cmgfi.com. That's jstanton at cmgfi.com. I'd be happy to show you what we can do. Thanks again, Dave. I really appreciate it. Thanks a lot, everybody. I'm Joshua Stanton, the Mortgage Dude. Have a great day.